Shaun, let me kick it off to you with this question. How serious do you think the U.S. yield curve inversion really is?
Well, I think this is a symptom of weak global growth and the push towards more QE, both in Japan, Europe, and eventually more QE coming in the US. So I think this is all about global growth rather than purely about the US heading into recession. We don't think there's a recession coming in the US, even though growth is definitely slowing there.
Does that mean that you want to stay invested in US equities right now then, Shaun, and to what extent, if so?
Yes, we have a big overweight to US equities. Also, we've been increasing our duration in long-dated treasuries, also in gilts as well. We think there's still room for long-dated treasuries to continue to rally well below this 2% level we breached yesterday. I think both bonds and equities can do well in this environment. Continued push of central banks to stimulate the global economy. The weakness is coming from China, I think, rather than any kind of G7 economy, and that's filtering through particularly into Japan and Europe. So the US will continue to do okay, not as well as it has done, but I think the push towards lower yields is coming.
So do you like the duration trade here in Europe as well? I mean, German 30-year bonds are already showing nominal negative yields. Do you buy those? Do you own them?
No, we don't. I think actually if you want to play that trade, you're better off owning long-dated gilts, actually. Your gilts offer a positive yield. That yield that is going to go to zero. I think, in our opinion, we're going to see some pretty aggressive rate cuts coming from the Bank of England, irrespective of your Brexit view, whether we get a hard Brexit in the short term or not. We still think UK rates are going lower, and gilts offer you that premium over bunds. So we wouldn't be buying a negative yield. I think there's a decent premium to be had at the moment in gilts.
Given what you said about the fact you're not as concerned about the US, but you are more concerned that the slowdown is coming from China, does that mean that while you're overweight in US equities, you're maybe a little bit more negative on emerging markets and even European equities?
Yes, so we've been very aggressive in reducing our Japanese and emerging market equity exposure this year. We still own emerging market hard currency bonds, a decent yield premium still there, which I think is relatively safe. But yeah, we're very underweight those assets that are most exposed to the trade conflicts, which we think is going to continue well into next year, given the US political cycle.